the PPI report today really didn't offer anything new, especially because the revisions made it look like PPI is just holding steady. We do think, though, that goods prices are removing or reversing their disinflation, even their deflation, and that's going to make it harder for sticky inflation to go down again. If services are strong and goods prices are starting to come back, it's going to be difficult. We think the Fed is probably on pause here for some time. And the market itself, if you look at the futures, has moved its only rate cut for this year all the way out to December. So maybe today is some wishful thinking if you're thinking the Fed may still cut.
Yeah, so that's pushing it back, Paul, right? They've actually pushed it down as well as just one cut, right? Now, of course, that depends on what happens to the economy, which also in turn depends on what happens with tariffs. And this is the thing, right? We're talking about the PPI coming in hot, right? But the PCE was benign, so all right, the yield goes edges back down. But this is all historical rear view mirror stuff, right? Which could turn on a dime depending on what happens with, let's say, tariffs. And we've got a bit of relief there because reciprocal tariffs, the president says, look, we're looking into them. We're studying them. They're not happening today. But, as and when they do, that changes the entire picture. That's one. And two, this whole Ukraine peace deal, that's not going to happen overnight as well. But when that does happen, that could obviously change the entire picture as well. And we've seen oil reacting downward, easing back because of that, no?
Yes, somewhat. You have to look at the terms of that deal because if it looks like it could give Russia an advantage, then there may still be issues between Russia and Western Europe in terms of the provision of energy. There may still be some sanctions, or there may still be some hesitancy to buy from Russia after 3 years of trying to find alternative sources. So I think we'd wait a little bit to see what the exact terms of any peace deal might be.
I see here that you favour US equities over international still, and that for 2025 you expect stock prices to end the year higher. Do you still feel that's a possible scenario if the Fed doesn't cut rates any further and yields continue to march higher?
Yes, we do. We're looking for inflation I'm talking about CPI now, in the 3 to 3.5% range. And when you think about large cap US equities, we believe that over the last several years, they've introduced enough, let's say, cost reduction measures that a little bit of inflation, let's say 3 to 3.5%, gives them a tailwind in their revenues. And we believe that the growth in the economy will be steady enough to provide about a 10% boost in earnings by year end. Add on another couple of percentage points of dividend, and you're looking at maybe a 12 or 13% pickup in stock prices, large cap stock prices. By the way, that's the median increase for the stock market, for the S&P 500 in the last 70 years. If you go back and look, there have been 8 times when there were 2 years in a row of 20+% gains. And the third year in 6 of those instances had a median of about 12.8%. So we're not looking for anything extraordinary, just looking for another double-digit year for the S&P, although it might be a little bit more modest than the last 2.